on in these markets today? Banks are down, and they're down big. It's Wednesday. It's September 6th, 2023. This is Overtime. I'm your host, Chris Vecchio, head of Futures and Forex here at tastylive, joined, of course, by head of Global Macro, Ilya Spivak, and right off the bat, coming from us across the pond in lovely old Italy, Dylan Ratigan. Dylan, good to see you again.
I realized I was supposed to have my screen blanked out. You kind of got me off guard. Part of my job here is to make sure that I turn my camera on and off at the right time, and I kind of already blew it coming in today, so I'll try to make up for it. But it's nice to see both of you. I hear this is the hottest new financial discussion on Wall Street. Overtime is apparently like a thing. So
that's what the fans
come one, come all, I say.
Dylan, this has been a really interesting week in markets. There's been another spike in U.S. Treasury yields. We've seen the banks come under pressure. Ilya is certainly not one to hide his opinion on OPEC. Ilya, why don't you set the stage here with a discussion on OPEC, and so we can pry Dylan's brain open about what he thinks about the latest cost production.
Well, can I just interject one thing? This is my third Wednesday with you, both of you all, and I know that it's a peculiar day. Yeah, like if Chris is not opening the show by spelling a word, like if he's not going UGLY or HAPPY. Man,
today we'll spell it OPEC.
Let's hear it, sir.
And I mean, I won't sugarcoat my skepticism of these guys' ability to do anything right. But the big story, obviously, seems to be that oil prices are back up. And interest rates are back up everywhere, seemingly in response, not just in the U.S., but in Europe, in Asia. And ostensibly, that's because people look at this and say, okay, this will be inflationary, and central banks, at the very least, aren't going to be able to cut in any kind of hurry. So we have to adjust to a world where interest rates are going to be higher because OPEC is going to do this, even though it's Saudi unilaterally, it looks like, with a little help from Russia. If you buy that, I don't. But if you buy that Saudi can be effective here, then, and the market says that maybe they will be, then this is what's going on. Obviously, we're a little bit insulated from this in the U.S. because we're effectively energy independent in a lot of ways now. But do you think this is, first of all, a real thing? Do we believe that they can do this, or is this the market just being spooked? And if they can do this and they can really hold up the price of oil, do you think this makes recession risk everywhere but the U.S. essentially that much greater and probably a certainty?
This is a question for me?
Yes.
Yeah, for sure. Of course, I have absolute confidence in their ability to manipulate oil prices. We saw it. I mean, go back to the beginning of the war. I mean, this is just like Germany. This is like the German bullseye. Like Germany's really been taking it. The brunt of the economic damage thus far has been borne by the Germans. Right? Because the Indians have profited by jacking up the price, buying the cheap Russian oil, refining it, and then selling it back to the Germans at 3 or 4 times what it used to be. This gives whether it's the Saudi agenda or whether it's the Russian agenda, both of those agendas are to accrue leverage, right? And the greatest leverage that they can accrue is against the European industrial economies, and the heart of the European industrial economy is Germany. I mean, I guess when you say, can they do it? It kind of speaks to two things. One, it speaks to like, are they organized enough that they're not going to cheat and there's not going to be a little something on the side and something for your grandmother and a little something for your friend and all that. I don't think the cheating, I think that they can manage the cheating because I think that they all see that it's in their self-interest to exert the leverage of the higher price. Like I think this is not a normal situation insofar as there's more disparate interests. I think there's more of a unified interest, which is let's assert our leverage. And so that's why I think that the cheating will be less of an issue. With that said, I tend to think that it's not until oil gets well north of $1.20. Like I don't like this is a higher oil price than it was, but to me this is not a high oil price. Right? You see, and so it's like okay, so oil price, yeah, it's higher, but what is it? I'm looking at Chris's screen. It was 87, 88.
Yeah, 87 and a half. It looks like.
I mean, that's the reason I'm a little skeptical as to how relevant this is in terms of being an economic headwind is not on the cheating or the price action, but it's on the absolute number is still not that high.
And I mean, we've seen oil much higher than this.
Call me when
much higher.
$1.50. Call me at $1.50, and then I'll tell you about a problem.
Right. You know? Right. I mean, my 2 cents is that I have absolutely no confidence in these guys whatsoever because they have not been able.
They're just uncoordinated and greedy.
The evidence seems to suggest it. So if we look at where they started this, which is what shale crashed the oil market about 2014, let's say, right? Since then, they have overproduced their quota by an average of 2.5 million barrels a day, and they've not met it once. Not one time.
They being Saudi or they being OPEC?
They being OPEC plus the collective sort of OPEC plus sympathizers. Obviously, Russia is the biggest of the sympathizers outside the club.
OPEC and friends.
OPEC and friends, yes. Okay. I think maybe the reason the Saudis are doing this themselves is because they don't trust it either. And they don't think they can corral all of these guys and herd all of these cats. I think this year it's been even worse. They've overproduced by about 3.2 million barrels a day, basically since the beginning of the year relative to quota. So for me, the first question is, okay, so let's say Saudi manages to cut 1 million through the end of the year, but OPEC is overproducing 3 times that relative to quota. How big of a deal is this? It's a cut, sure, but is it a big cut? I don't know. It seems like the market is giving them more credit than they deserve. The other thing is, if you look back, let's call it 2018, 2019, it seems like the price is leading the output. So you get a top in the WTI benchmark. A few months later, you get a top in OPEC output. You get a bottom. A few months later, you get a bottom. So to your point, it seems like they're greedy. They're essentially saying when the price is falling, we want to pump less. When the price is rising, we want to pump more, which is self-defeating to the entire thing.
Chris? I mean, I just don't see how this creates as relevant. I have 2 things that occur to me. One, I don't, at an absolute level, oil in the 80s or even the 90s, not that big of a deal economically.
Sure.
At the same time, every time oil goes up a little bit, the Tesla bulls are like, oh, it's good for Tesla stock, right? And so, but I also feel like basically anything could happen. It can rain and it's good for Tesla stock. It could be sunny, good for Tesla stock. Oil could go down. It's good for Tesla stock. Tesla can raise prices. It's good for Tesla stock. Tesla could cut prices. And so I do think that higher oil prices are actually good for Tesla stock, with all that said.
I mean, they have been recently. That actually
of all the things good for Tesla stock, that one actually makes sense.
Yeah.
The 1-month rolling correlation between Tesla and crude oil prices right now is 0.62. It's the highest that it's been going back to the middle, we can call it late part of July, I guess, July 20th here. I mean, I think about rising energy prices being a problem for some of these countries that have seen their currencies weaken so much. I mean, Asian currencies, a basket of Asian currencies, if you're looking at like the Indian rupee, you throw the Chinese yuan in there, the Korean won, the Japanese yen, it's at a 10-month low. And these countries consume a great deal of energy. And so now not only is oil going up in dollar terms, but then it's really going up a lot more in their local currency terms. And so that could be a wrench in the global economy. But I'm really concerned about Germany here. I mean, Ilya was showing me a decomposition before of German producer prices or consumer prices. We were looking at the HCOB PMI, and energy has not been problematic in recent months.
Share that chart if you want.
Yeah, absolutely. Feel free to do so. And that to me is this hasn't been an issue, and yet we're still seeing some struggles going on here in Europe's largest economy. And now energy is becoming a bit more problematic in the short term. Sure, year over year, energy prices are down, so there's still been disinflationary pressures. But as time marches forward and we see energy prices hold up, Germany then can see a greater pullback in their industrial and their manufacturing capacity. And this is a country that's been, I don't know, I don't want to use this term lightly, but they've been held hostage by their anti-nuclear left wing. They have 7 nuclear reactors offline right now that they could flip on, in a moment's notice. You need some time, obviously, to get things started. But this is a country that has the capacity to meet its energy needs and is almost choosing to handicap itself. I think about the political ramifications of this too. You've seen parties like AfD in Germany gain more power in recent years. If Germany falls by the wayside over the next few months because of another spike in energy prices, this could be a rippling effect that ultimately, and do we think about a Eurozone crisis once more? That's been something off the radar for the past several years.
Well, the other thing that comes in is the biggest point of leverage in Europe relative to the war between Russia and Ukraine is to get Germany to break ranks. Right, like that they are the weak hand, as it were, in the unified front in support of Ukraine. And I actually think part of the motivation in raising the oil prices is to squeeze the Germans to start to try to break that alignment between Western Europe and the United States as it relates to the conflict.
So, if you guys can see this is a breakdown of the sectors driving German CPI. And if we looked at the Eurozone one, it basically looks exactly the same. So if we looked at region-wide, it's essentially identical. The difference is the headline number is 5.3. In Germany, it's higher. It's 6.4. And the thing you see here, that light gray area, that's energy. So electricity, gas, and you can see that there's been massive disinflation there. And that's been the main sort of way that disinflation has occurred here since last year. Now, most of this is not oil. Most of this is gas. The gas is down something like 70% from the peak after the initial war started. And obviously markets freaked out then, but since then, both wheat and gas, actually the two big Russian exports, have been absolutely tanking. My theory on this is the Russians can get money, but from so many things, they only have so many loopholes in the sanctions, so they're flooding the market to keep market share. Obviously, I don't know that, but that's my theory, because it's weird that the two commodities that are supposed to be the most hampered by this war are also the least hampered and the most down. So the thing that jumps out at me here is food. And where this gets really unexpected, because obviously the thing you want to believe when you look at something like this is, oh, well, of course it's food, grain, right? We've disrupted grain because wheat out of Ukraine and Russia is a big deal. But when you look at what's been going on with grain versus other soft commodities that would go into food, it's not grain. Grain seems to have topped early in the war. That's that yellow line there, and come down since. It seems to be soft commodities. And there, it seems to be sugar. And sugar is protectionism from India, which has decided that they're going to cap sugar exports. Now, Brazil was supposed to have a bumper crop in sugar, and that was supposed to relieve all this, which is why you can see it's kind of back down now. But of course, the fear is that energy is also perking up. If you believe OPEC can get this stuff done, then the energy index there, you can see in the red, is starting to come back in. So sort of the ECB nightmare is the thing in softs eases, but then energy takes over and you're stuck again. Obviously, there's not much you can do with sugar prices by raising rates. You can't tell people, you know what, food inflation is too high, don't eat. So what are you going to do if you're the ECB?
The bottom line is the probability of the probability of a weaker economy has gone up.
Right.
No question.
I mean, that's not that that's some grave insight on my part, but I mean, that's compared to when we spoke a week ago, the marginal probability of a weaker economy today relative to the data 7 days ago is a higher probability of a weaker economy today.
Yeah.
But I don't know how relevant, you know, the thing is, so much of the economic activity revolves around the US economy and then the Chinese economy. I don't know how, like when Chris is asking, oh, we're going to have a Eurozone crisis, and I kind of wonder how much it matters what happens. I mean, it matters in Germany for Germany, matters in Italy for Italy, matters in France for France, et cetera, et cetera. But does it matter to the world? I mean,
so Eurozone economy is about 15% of global GDP. China is about 18, US is about 24. So in that order.
Yeah. So it matters, but again, it doesn't have primacy.
No.
Not anymore. And quite
really
frankly,
extreme. Sorry, Chris, go ahead.
well, I mean, since 2007, 2008, when the Eurozone economy and U.S. economies were basically on equal footing, the U.S. economy has grown a great deal since then. And the Eurozone economy is effectively flat over the last 15 years. It's lost its share of global GDP, not because other economies necessarily have grown faster than it, but on its own standalone basis. It just hasn't moved anywhere quick. And that's perhaps because of the Eurozone debt crisis and mismanagement of policy across the board.
Also, the demographics. I mean,
yes.
Oh, well, European demographics are a
Yes.
nightmare.
Yeah.
They're an absolute nightmare.
Yes. I mean, if ever there was the parallel with Japan, this is it. Like Japan is stuck in a demographic nightmare. Western Europe is very much, in my mind, in that same nightmare. With maybe a lost decade, maybe ages of low consumption, no inflation, low interest rates, all of these things.
No growth. Thus, you want to be long Nigeria and Mexico.
Mexico for sure. Nigeria, I haven't looked at, but Mexico for sure. Argentina for sure. All of these things that have much better demographics.
I mean, don't you think Mexico is basically like the darling of the world the next 10 years?
I do.
Unless
I
they
do.
F it up themselves. I don't know, you know, however that can be done, but
Yeah, I do.
Or we screw it up.
yeah.
Yeah. We certainly have a penchant to. We've done it before. But yeah, I'm very optimistic about Mexico, about Canada. In my mind, it's a deglobalization into kind of regions, and the regions are globalized within themselves. And the Western Hemisphere with the U.S. as a kind of like Monroe Doctrine kind of player, basically saying, this is our backyard. We're going to build our own thing here now. You all enjoy. We gave you 40 years of protecting your shipping and you got prosperity, but we're tired now and we're done. So we're just going to protect our little corner here. And we have everything that we need because we have all the labor that's underdeveloped in South America, and we have Canada. They're next door. So we're okay. You all enjoy.
That's isolationist.
Yeah, well, I don't support it. I just think that's where it's going.
I agree with it.
I just think that's where it's going. I don't like it.
No, unfortunately, that does seem like the direction it's going, which probably means higher structural inflation moving forward. Globalized economy has brought down price pressures and lifted hundreds of millions, billions of people out of poverty over the last 50 years. And so that would not portend to a better set of circumstances. And, more division on a global scale probably increases the odds of geopolitical conflict down the line. But that's another story for another time. Dylan, I think that we really want to get onto this regional banking issue.
Yes.
And I say that because it's long been my belief since the SVB and Signature Bank crisis began back in March of this year. The way that the federal government responded was effectively by saying to the big banks, we've given you guys so much money over the years. We will set up these liquidity facilities to help patch things over, to paper over things. But if there is any bank failure, it's first and foremost your responsibility to clean it up. And the big banks have benefited. JP Morgan, you look at their financial results from last quarter, and First Republic was a big addition to their bottom line. And so as far as I'm concerned, regulators have given the big banks a green light to absorb their smaller competitors.
Pick the corpses. Go ahead.
Well, and a lot of banks are effectively zombie banks at this point in time. Absent federal intervention, you could make a case that depositors would have fled otherwise. They have these large, growing unrealized losses on their balance sheets thanks to their held-to-maturity securities, which they don't mark to market for tax and accounting reasons. The most recent spike in interest rates and bump higher in oil prices is certainly laying to waste regional banks once more. KRE this week is really taking it on the chin. Today was another bad session, leading the Russell to the downside. That's usually not a good thing. In the process, at least on a technical basis here, more to Ilya's perspective, we're seeing here that the banks are starting to break down once more. Dylan, talk to me about whether or not this is a good thing ultimately for the U.S. Canada famously has 4 banks. The United States has
many countries have, right? So go back to in the 1990s.
Sure.
Raj Cohen is the big lawyer at Sullivan and Cromwell. Gary Parr is the head of financial institutions banking at Morgan Stanley. Chris Flowers is the head of financial institutions banking at Goldman Sachs. And the three of them, along with a handful of other people, are basically saying, we're going to turn whatever it is, 10,000 regional banks in the United States into 50 banks. Right. This is and so the way I look at this is we've been in that process of that consolidation for whatever it is, 25 years now. And it goes in fits and starts. And every time this regional banks get inside out, and because the competitive gap between the super banks and the regional banks, it creates an increasing disadvantage over time, which then means that the regional banks are basically doomed to have a weaker hand because they don't have the subsidies that are too big to fail. They don't have all the things everybody knows about. Lay into everything that's happened in housing. My new theory is that housing is going to start to clear down 20 or 25%.
I would agree with that.
That basically you're going to start to see trades in 24. California, all these, and you're going to see prices that are down 20 to 30% on average. The regional banks will get pounded for that, not to mention everything that you've already discussed, Chris, whether it's on the rate side or whatever. Anyway, long-winded way of saying regional banks are screwed, fully screwed. I don't even know if there's a play on the equity side, because the thing is, it's gotten to the point where if you're one of the big banks, why bother paying for the equity when you can just wait for them to rot themselves out and pick them up with no equity value and just assume their balance sheet? I mean, that's what JP Morgan has done, going back to Bear Stearns for $2 a share in 2008. So, yeah, I mean, and this is from somebody who bought First Republic shares in the early days right after Silicon Valley, made money because we came back, didn't sell, and then watched the whole thing unravel. I do not see a path for the regional banks.
This week, regional banks, I said before, they are down. Now on the week, we're talking about a 2.24% loss here, 4.52% loss. There is a month of September that started last week. So technically speaking, we have struggled a little bit. In any event, XLF has outperformed the regional banks by 3.61% this week. The big banks are holding up. They're not doing well, but on a relative basis, they continue to outperform their smaller counterparts. I don't know if there's another shoe to drop, right? We don't know what other skeletons are going to fall out of the closet. But the longer we go forward in time where interest rates stay up, it just gives people less of a reason to stick around. And it's incredible.
And as the housing market starts to actually clear, which it will, down 20%, that's going to cause some recalculating of some math.
Well, it's not just the housing market, right? It's commercial real estate too.
Yeah.
I mean, that's how a lot of these regional banks made their buck in the 2010s.
A ton of it. A giant pile of it.
And work from home is here to stay. Whether or not people like it or not, you see the surveys, you see the data. People have not started returning to the office. You may hear Goldman Sachs saying you got to get people back to work, or Google saying you got to get people back to work. And if you don't relocate for work, well, then you can't work here. And workers right now are saying, okay, I can find another job. And ironically, all three of us are working from home, technically speaking, right now.
That's right.
So, we're very much in the camp of having an employer that lets us do that. But even when employers have tried to put the squeeze on it, workers are just saying, no thanks. I enjoy the flexibility and the freedom. And so vacancy rates and overall, we want to call it attendance rates, if you will, in these commercial real estate centers, if it's New York, if it's San Francisco, they're just not rebounding.
I mean, New York and San Francisco specifically.
Yes.
Of all the cities, those two, I think, are specifically like. So all those banks that are behind all those towers in both of those cities, forget about it.
In San Francisco, it's a double whammy too, because tech also. Yeah, it's the banks, it's tech. Nobody wants to go back in, and downtown is. I mean, obviously, we see all of the hysterical videos. That's about a 4 or 5 block radius,
and then throw rates, and then throw rates. I mean, come on.
Yeah, exactly. No, I couldn't agree. I couldn't agree more. I think this is a ticking time bomb, and a correction in housing would absolutely scorch it.
Okay, so Dylan, is it a problem if we see consolidation in the banking sector? Or is that just a? I mean,
that's a question for 25 years ago. Irrelevant. It's a fait accompli. Sure, it's a problem insofar as in an optimized economy, you have multiple small banks that are doing a more diverse assessment of credit and creating a better quilt or fabric of enterprise, both residential real estate, small business lending, commercial, all these things, farms. It never ends. And as you consolidate the vast majority of the credit in what amounts to 4 banks, maybe 5 if you throw in PNC. They're all running the same algorithm. They're all running the same. There's zero diversity in the credit market, which may be good for investors and shareholders, but it creates what amounts to a monoculture in the economy in terms of the nature and types of credit that gets issued and what it gets used for, which ultimately makes for a more fragile economy. Tom Sosnoff talks all the time about how Chicago is uniquely strong in the economic sense because unlike San Francisco, which is obviously massively tech dependent, Los Angeles entertainment dependent, New York finance dependent, that Chicago has more diversity in its economic mix that makes it more durable or has more durability. And I think that the same thing is said when you have a smaller banks issuing credit, you have a more durable economy. When you have all the same credit from the same 4 banks, you end up with a more fragile economy. The offset to fragility is you end up with a more efficient economy, right? The higher efficiency, higher liquidity, higher velocity, the more fragility. And also you have what amounts to the consolidation of power, not even with like a credit committee, but with a credit algorithm. that is more or less what's being used at Citi, JP Morgan, B of A. That the idea of any tactile relationship with enterprise is entirely a throwback at this point. I mean, I would say my question is,
Sure.
From an investment standpoint, do you want to be short the regional banks? Do you want to be long the home builders? If you listen to the home building CEOs, they think they have the upper hand for the next 5 years because the housing market is so screwed up.
I couldn't agree more with the home builders. I think the home builders are really well positioned. It's been a really stable rally going back nearly a year now. In fact, we can go back to the lows that we had last October. So this uptrend is nearly a year long. We haven't really gone much of anywhere for the past few months. So in terms of this being like an overbought kind of trade, that momentum has truly cooled off. Yesterday was a bloodbath. Today we see a little bit more of a rebound, which I suppose is a good thing when you consider the fact that rates were up and energy was up again, like it was yesterday. But the housing market here in the U.S. is so screwed up. And these higher mortgage rates, whether people want to consider this or not, I mean, they're golden handcuffs. There's a big difference between the structure of the housing market now than in 2007, 2008. And this is like my little bone to pick with people when I see folks on Twitter or X now saying that the housing market is about to crash. And perhaps this speaks to your point too, Dylan. In 2007, 2008, 32% of people own their homes outright. And among all mortgage holders, 45% were adjustable rate mortgages. And so when rates shot up, people are screwed. Now, here we are in 2023, 40% of homes are owned outright, no mortgage attached. And of the people that do have mortgages, 95% are fixed rate. So it doesn't matter that the prevailing mortgage rate in the country right now is 7% if you're a new home buyer, because the people who are in their homes, they're paying on average 3.6%. So you're not going to sell your home.
But that just goes to the home builders then, because what you're basically just saying is there will be no transactions. There will be
won't be any. The market's free.
And there's not now. We're down to only 1 million.
And there will be none because of those fixed.
Yeah, and this is an illiquid market. Listen, my wife's in real estate. She's saying that there's people do not want to move. They just do not want to move right now because they go, well, if I want to get a bigger place, I'm gonna have to pay more money. So if I downsize, I'm gonna pay the same amount of money because I'm gonna have to get out a mortgage. I don't have a mortgage. I don't want to do that, right? So people just aren't selling. I mean, anecdotally, my parents, when I moved closer to them, they said, well, we were gonna sell our house, but now that you guys are in the area, there's no point to. We're gonna want to be close by. And so they don't have a mortgage, and they're like, plus, like, if we have to go out and get a mortgage, we pay 7%. Like, no, there's just no reason.
To your point, the average rate on outstanding mortgage debt now is 3.6%. Mm-hmm. The average rate to get a new mortgage is 7.6. Who in the world is going out there and going, you know what? I'm going to sell this thing, and then I'm going to finance something 400 basis points higher.
I mean, not to mention all the IOs. I mean, there's all the others. I mean, there's just layers and layers.
Yeah.
The point is, we should be buying. I should own some home builder stocks.
ITB is looking at you straight in the face, Dylan, and quite frankly, I would enjoy having more people along for the ride with me. It could be a fun few months.
I might be there soon because this narrative makes a lot of sense to me. I mean, I am, as ever, always fearful of correlations going to one when some sort of crisis hits and sector differentiation goes out the window and people go, you know what, we're selling equities. We don't care that there's a story in home builders. We're selling it all. So because I am really bearish about where the business cycle is going now, I'm looking at this and going, okay, well, I like this story. I just don't want to get run over if correlations go to one and everybody is dumping everything. But the story, the macro of it, the narrative makes perfect sense.
And I'm with Ilya for better or worse. And that I feel that my fundamental point of view is this entire stock market must go lower.
Yeah. Yeah.
But that also hasn't been true. And what the hell do I know?
The problem is it won't roll over.
And are they really going to let it roll over before an election year? I mean, we're getting into the teeth of it. There's nothing that will scare people more at the voting booth than higher energy prices, higher inflation, a crashing stock market. It's a recession when your neighbor loses their home. It's a depression when you lose your home. And so I have a feeling that we're going to see additional efforts like we do every 4 years, regardless of which party is in power, to make sure that the economy's been on strong footing before people get to that voting booth in November. Dylan, we're not going to see you for
was an election year.
08 was an election year, and look what happened. The party that was in charge of an economy that was cratering got taken out in 2016.
Yeah.
The economy was stuttering, and so the White House switched hands in 2020. I think there's a very strong case that if there's no COVID, Trump wins a second term, right? If the economy is dealing with high inflation next year and the stock market's down, Biden, and maybe it's not Biden as the nominee, Harris or whoever steps in, the Democrats have a lower chance of winning it. And the Republicans, regardless of what's going on in the party itself, people want a change in leadership when things are going bad. Plain and simple. That's just human nature. We want to try something different. And so voters very well may make that choice. Dylan, we don't want to keep you around forever because we know it's getting late over in beautiful Milan. Are there any final thoughts that have been on your mind this week that you didn't get to express on today's episode of Truth or Skepticism with Tom? Maybe because you didn't want to hurt Tom's feelings or you were saving it for us. But any final closing thoughts?
The only reason that I can think of that this entire stock market is not going to get absolutely shellacked is the fact that everybody expects it to get shellacked.
Yeah.
Sentiment has deteriorated.
My only difference there is I think they were all expecting it to get shellacked in the first half of the year, and so it rallied in their face. Now everybody thinks that we're going to have the beautiful soft landing. So maybe now it's time to get shellacked.
From your mouth to God's ears. and then we can buy the home.
Or I'm going to lose a bunch of money.
As someone on the other side of the trade, let me tell you, I think everyone in my generation is banking on the stock market going up. We're looking at you, Apple. Apple, you're basically the millennial generation's retirement plan.
And Tesla. Don't forget Tesla. Any sun, rain, high, low, anything. Everything is Tesla positive.
I had buy orders, and I had a close friend he lives in Kenya now, and he was visiting the United States a few months back, actually in December, and he goes, "What do you think about Tesla's share price?" I said, "Well, I think Tesla has a Twitter problem, but if it gets to $100 a share, I will buy a whole bunch of it." And so I had buy orders in, and I think Tesla bottomed out at $101.02. So I didn't get any, and now I feel like a bit of a jerk for not buying it and just being, being such a stickler on the price. Sometimes when you're looking at a stock that's big and there's such a big fall, you got to dip your toe in when it gets close enough to your entry target and not really pinch pennies there. And I was pinching pennies, and I was waiting for the prices right, and I was wrong. So I missed out on the rally this year in Tesla.
They just got to put more bubble eye lenses on everything, on the phones, on the cars. That'll get them to buy it.
That will be fine. Dylan, it's always a pleasure to have you here at Overtime. We appreciate your time here once again this week. We're looking forward to seeing you next week.
Absolutely.
You guys have the hottest show on Wall Street here, so I'm honored to get to turn up. At least
if you're saying it must be true. If you're saying it must be true.
There it is.
I told Sosnoff, I said, listen, these guys are smart because they invited me to join them.
See, there you go.
Excellent. Thank you so much, Dylan. We'll see you next week.
All right.
Thanks,
bye,
Dylan.
guys. Bye-bye.
Ilya, when we take a look at these markets here as we get through the end of this trading day, futures markets closed just about 15 minutes ago. S&P 500 staves off some of its bigger losses on the session, ends up closing down by 0.69%. You can see the candle there on the screen, that lower wick. It's not a pretty, exact shooting star or hammer, but it does suggest there was some buying interest into the end of the session. NQ as well, a little bit of a rebound, catching on its 1 month moving average, off by 0.87%. And it is the loser. One of the tells this morning, Thomas and I were writing that 5 Futures in Focus article.
Yeah.
And we couldn't help but notice that after several days of stocks being down because rates were up, interest rates were down this morning before the U.S. cash equity opened, before the ISM services report was released, and yet the NASDAQ was still struggling. And so when it can't benefit when rates are coming in, well, that typically is a warning sign. And sure enough, when rates do spike later in the day, the NASDAQ does get hit hard. Russell's off by another 0.35, but the bigger news, of course, is what's happening in KRE here today. The regional banks, they do see a little bit of a rebound later in the day, but let me tell you about that rebound, Ilya. it was basically nothing because KRE still finishes down by 2.31%. In terms of our sector performance on a day where oil goes up, we see rates mostly move higher. It's the banks that are the big losers. Semiconductors are also up there, but not nearly as bad. Banks are down 2.31% for the regionals. KBE, the S&P Bank ETF, is off by 2.1. Semiconductors are the third worst performer, down 1.16%. In terms of people on the positive side, ITB up by 1.03%. OIH, oil services, up by 0.35. XLE up by 0.04. Otherwise, it's pretty much just a mixed lower session overall. This isn't that alarming of price action, right? You're down by 0.5%, 0.75% in that neighborhood across the board. But it's still not a comfortable day given everything that's going on around the world. There hasn't been much of a U.S. macro focus this week. U.S. earnings releases obviously have tapered off. ISM services is very important, of course. But in this week of immaterial is probably the wrong word, but less important U.S. macro data, there's no NFP, there's no Fed, there's no CPI, there's no GDP. The attention has turned back abroad. And when you look abroad, there's really not much to like
at all.
Is this now setting up a problem for next week's CPI release where we're almost guaranteed to see another bump higher?
It's starting to look pretty ugly when you put everything together. And one of the not very closely paid attention to numbers that frankly should be paid attention to more. We got the revised set of US PMIs today. Now, typically the revised set isn't anything anybody pays very much attention to because by the time it comes out, it's kind of done and dusted. The response has been had. It's actually really important here, in my view, because the numbers were worse than expected. They gave us the slowest U.S. economic activity growth that we've had since the beginning of the year. And that's after a peak in May. So growth peaked in May and is now near standstill. 50.2 was the composite PMI number. The reason this is so important, I think, is because in markets where there's a positive global business cycle, all the economic data is revised higher. You get a flash number, then more evidence comes in, and it turns out things are better because the general business cycle is better. So when you get more information, that more information ends up being a revision higher when the business cycle is on an upturn. It's baseline arithmetic. When you're in a downturn, all the revisions are going the other way.
Right.
And all of the revisions are down. We've now seen revisions down in Europe across their PMIs last week. The numbers that are supposed to be coming out of China, you can look at the Caixin numbers, which are the private sector PMI numbers if you don't trust Beijing's numbers. You can look at Beijing's numbers. They're equally awful. There are differences here or there, but they're terrible. The economy in China is basically at a standstill by their measures. They're a faster growing kind of catch-up economy. So for them, let's say a 3% growth rate might as well be a recession in U.S. terms or Eurozone terms. So when you look at that, you look at the revisions in Europe, you look at the revisions in the U.S., you start to get the sense that the global economy as a whole is contracting, or at least very close to contracting. And indeed, once this round of PMIs fully runs its course, we're going to get the global PMI numbers that are sort of the catch-all for all of it. They come from J.P. Morgan and S&P together. And it's the same story. We had a bump in services at the beginning of the year. It looks like there was a bunch of still lingering unspent demand on things like concerts and restaurants and on travel, where last year was not something that people were still engaging with, but seemingly in the first half of this year, there was a bit of a bump to services all around the world. That has now faded everywhere. And so it seems like we're in this kind of global coordinated downswing in the business cycle. The news overnight out of the range of economies, not good. Certainly, the story in China is just one part of it. If we look at what's going on more broadly, it's more evidence of bad things afoot. So retail sales in the euro area down again, this time 0.2%. Factory orders in Germany. The expectation was that they'd be down 4.5% year on year. They were down 10.5%. The month-on-month number was supposed to be down 4.3%. It was down 11.7%. So this is bad. These numbers are bad. There's a coordinated global recession that's very close to being realized here. I think the main question for markets now, and I think perhaps the reason that they're so spooked, is they think that because of this oil thing, central banks are not going to be able to quickly turn around and go, whoa, 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 whoa. We've gone too far. Less cowbell. Let's have some rate cuts. And if the price of oil keeps surging like this, that's going to be a very tough sell.
Yeah, you can see here the German stock market, which we can use the DAX ETF, DAX ETF as a proxy for. You can see it's been struggling here much more than its U.S. counterparts.
Yeah.
In fact, it's holding near some of the lowest levels that we've seen going back to last March, or March of this year. The U.S. is holding up much better. Germany's data has been poor. They have a number of structural problems with their energy sector. While, as you pointed out, it's been disinflationary, although, I would argue that's a base effect thing. Last year, European energy prices hit their peak in August. So, of course, this time of the year, here in 2023, they will be lower. But we're rolling away from that now. And as we make our way through the next few months, what became a structural disinflationary base effect is going to be neutralized. And the data becomes a lot more sensitive to these upticks in energy prices. So really, there's no way to look at it in a positive light, at least the way that I'm concerned. The euro obviously looks like it's in trouble. German equities look like they're in trouble. If Germany's falling apart, then that's bad news for Italy, for France, for Spain. It can become a nightmare quickly. Although I would want to shift the conversation here in the final few minutes to the British pound, because a year ago today, Liz Truss was named prime minister. She introduced a slew of supply-side economic reforms that nearly killed the country's pension industry, that required intervention from the Bank of England. She ultimately did not outlast a head of lettuce from a local grocery store. And so she was on her way out.
Yes.
I saw a survey today saying that the UK has become less investable as a destination, and people have less faith in the UK economy than they have at any point over the last, say, 7 years. And why do I say 7 years? Because just over 7 years ago, we got the vote for Brexit, June 24th, 2016.
Yeah.
You've had 3 prime ministers in the past year plus, right? You've had 4 finance ministers in the past year plus. Political instability is a very legitimate problem. And now you have this ongoing cost of living crisis here. And so the U.S. economy may have its own issues, right? Student debt loan repayments coming down the pipeline, higher energy costs filtering through. We haven't necessarily seen that go up to the pump yet, but it doesn't matter because so much of investing is about opportunity cost and about relative appeal between assets. And so you have to put your money somewhere. The UK is just not attracting it right now. I know we put a lot of attention on the euro as being our main focus here because it's the largest component of the dollar index, 57.6%. But the pound isn't nothing. It's 11.9.
It's very important.
The pound falling apart again. Now, this is the fresh monthly low. It's a lower low than we had in August. It's the lowest level that we've seen since the middle of June. Quietly, the pound is grinding to the downside right now. I mean, are you concerned about the UK and short pound? Is that still very much on your radar as an opportunity, even though the breakdown's been going on for several weeks?
I have it. So the pop last week was something that got me out of my 6B short. I was short from about 130, and that was a good trade. It worked. Last week's pop kind of freaked me out a little bit, and so that was actually the only place where I unwound my long dollar short G10 FX exposure was against the pound. I got back in basically over the Labor Day weekend because I thought that the move had run its course and basically hit former support turn resistance in that congestion area that you're outlining right there. So if you see the latest 3 green candles there before the rollover, you can see that there was a congestion area there right under about 128 or so, and it ran there and stalled. So once it stalled there, I thought the risk reward to going back lower seemed attractive. So I'd take a stab at it. And then once it cracked that triangle bottom you put in there, I added to full size. Very helpful overnight here. We had some comments from Bank of England Governor Andrew Bailey, who said that the expectations for disinflation in the year ahead are marked, quote unquote, and that interest rates are, again, quote unquote, near the top of the cycle at this point. So this has been one of the places where rate hikes have been very adamantly on the cards. The ECB at this point maybe will go again this year, maybe not. Odds are still better than even, but they're down from a certainty. The Bank of England was expected to keep hiking at least a few more times from here. So the commentary here seems to suggest that central banks are starting to basically look at this and say, well, what's going to change? And the problem in the UK is very much like the problem in the US and less like the problem in the Eurozone. The inflation's in these areas, and perhaps this is why the UK is even more important to look at. These inflations are not the same. The inflation in the euro area is primarily a goods inflation. It's primarily, as we were just talking with Dylan, a function of food inflation. And there it's primarily imported sugar, it seems like, is kind of the main shock there, where energy has been squeezed out. In the US, as it is in the UK, it's primarily a service sector and a labor market being sticky kind of thing. It's not a shortage yet in the UK. It's a shortage in the US. In the UK, it's just a very, very tight labor market with basically not a worker to spare. And there's not much you're going to do about that unless the business cycle really turns and the squeeze is really applied and you hurt demand. Because manufacturing labor supply out of thin air is not a near-term sort of thing. Canada is actually a great example. They've had a popular, incredibly voter-supported immigration effort where they said, listen, we need to up our immigration quotas. We need a bunch more people because these labor shortages are killing us. We need way more workers to ease this issue. And it's not worked. And not because they don't want to have a big immigration effort. They do. Not because the voters there don't support the government in that effort. They do. It's incredibly popular. It's one of the few spots where you can point and say, here's a developed economy that wants a lot more immigrants. But they haven't been able to fill the right skills gaps. And so the shortages persist because you're not going to say, you know what, I need X thousand more of this type of engineer and then that amount just gets pumped out of a 3D printer somewhere. That's not how that goes. So the only thing to do here is to hurt demand. And it seems like the central bank now thinks they've hurt it enough, or close to enough. And that now the thing is we're heading into this more recessionary environment that will hurt inflation because it will hurt the demand. And labor markets will reset because wage agreements will reset because a bunch of people are going to get fired.
There is a simple solution, of course, to filling job openings. Pay people more money, but
yes,
we don't want to touch that third rail here. Certainly not when time is running out on this episode of Overtime. To watch Overtime, you could do so every Monday through Thursday, 4:30 Eastern, 4:30 Eastern, 3:30 Central Time, excuse me. You can follow Ilya on Twitter, X, at Ilya Spivak. Overtime is now out of time, of course. Follow me on Twitter, at CVecchioFX. You can always catch more of Ilya up next on Macro Money. See you folks tomorrow.
Godspeed.